Managing Money and Finances, Managing Money Successfully, Part 2. So what's money? What's finance? What's the difference between bartering and money? Collins points out that money is related to exchange, measure, and store. That is, anything commonly accepted as a medium of exchange, measure of value, and a store of value. It's related to the functional areas of business that we've touched upon, accounting and finance. Bartering is just simply trading stuff for stuff. It's very difficult to determine the value, and stuff cannot always be saved. Money, on the other hand, is divisible, portable, durable, generally hard to counterfeit, easy to state the price, and it stores value. Those are a few of the differences between bartering and money. Finance relates to all of the activities involved in planning for, obtaining, and managing a company's funds. Let's dig into this a little bit more. And we will, but let's first look at why is money so important? Why does money matter? Why do we care from a big picture perspective? Simply, it's important because you need it to do business. Leaders, business managers, even individuals, as well as government officials, make numerous financial related decisions daily that impact business survival and growth, and those decisions have implications around the world. How does it work? And this is where we dig in to a little bit the role of financial manager. Financial manager within the firm determines how much money the company needs and where it will get the necessary funds and how and when it will repay the money back. A big part of the financial manager's life is financial planning, asking questions such as how much do we need, how will we get the money, and how will we make financing decisions. In assessing need, there is often an estimate of sales or revenues as well as costs. Likewise, when you start to think about where the money sources will come from, it's the owner's personal assets. Often, in early startup businesses, it's family and friends that believe in you even when others don't, and sometimes they're more traditional sources like bank loans. We'll look at that in a moment when we think about Nike. How will we make financing decisions? Well, you can take equity and go public and with stocks, or consider debt and bonds. When we think about the Nike case 13.1, paying by the rules, let's broadly look at some what, why, and how questions, and then see how financing and financing decisions played out at Nike. What has been Nike, or its predecessor Blue Ribbon Sports' financial management approach? Why has financial management strategy been important to Nike historically and going forward? How did Nike obtain the needed funds? And we'll look at personal assets, loans from family and friends, bank loans, private investments, letters of credit, public offerings, etc., to start and expand its operations. Let's take a closer look at business case 13.1, paying by the rules, Nike. In the early years, it was an initial investment by the two partners, Phil Knight and Bill Bowerman. I think they both put in about $500, so $1,000, but that didn't get them very far. They then had to get a letter of credit from a local bank in Oregon, the Bank of Portland. They were working with a Japanese partner, and the Japanese partner was good until the Japanese partner changed the terms and required that Nike just not buy and pay for 300 shoes, but 8,000 shoes. Nike was then in trouble. They could sell 300 shoes and pay off their loans, but 8,000, that was going to be hard. The Oregon Bank became displeased with Nike's financial management, basically withdrew their support or letter of credit, and Nike was stuck to scramble and borrow cash from family and friends. What do you do when you're a security risk? The banks in Oregon wanted no part of Nike, but Nike had a friend who helped them secure a traditional loan from a California bank. So that was secured debt. And then from family and friends or private investors, they had unsecured debt. But the promise was that if and when Nike would go public and trade stock, then these private investors would have stock that would be converted and they would get their return then. Nike was faced with those operation challenges. They have these shoes coming in and they need to pay for those shoes from Japan and sell those shoes. There was a real cash crunch. A Japanese trading house, Nisho Iwai, put money into the bank on Nike's behalf. They believed in Nike and they thought they'd give them a chance. And so when Nike had the financing secured, they could buy shoes from Japan and then sell in the US. So for a while they were doing okay. But on the side, Phil Knight ended up deciding that he wanted to manufacture the shoes in the US. And the $250,000 loan they got from Nisho Iwai, the Japanese trading house, actually he put that money into refurbish a manufacturing or old shoe factory in New Hampshire. So instead of using the money to pay back the bank and creditors, pay employee salaries, Phil Knight put it into refurbishing a shoe factory. He didn't use the money for its intended use. Nisho Iwai, who had loaned them the money, was not happy at all with this decision. But they also didn't want Nike to go bankrupt because then they would lose their initial investment. So they ended up bailing out Nike. And eventually Nike did go public. They needed capital. They went public, that is, they traded on the stock market, and they raised $28 million. I think the year was 1980. And in gratitude for Nisho Iwai supporting them during those hard years, even when they made bad managerial decisions, Nisho Iwai received 300 shares of preferred stock, which turned out to be a really good investment for them. Also, if you go to the Nike campus in Oregon, their headquarter campus, there's a street named after Nisho Iwai. So that's a little bit about Nike's journey in finance and paying by the rules. Let's take a moment and talk a little bit about your money and managing financial resources. Personal finance. A lot of the principles that relate to corporate finance also apply to ourselves as individuals. And this could be true for you individually or even your family in the future. Financial planning is the ongoing process of managing your personal finances to meet goals that you've set for yourself or your family. Here you can kind of see the financial planning life cycle. Early on, when you're young, a young adult, you're in the building of wealth stage. You may eventually get married and take on some debt. If you buy a house, you're consuming and saving, maybe you buy some insurance, you're investing. But in stage 2, you're preserving and increasing wealth. You're starting to think about the other side of life. Your family's matured, and you're thinking maybe even about your retirement. And then stage 3 would be living off the saved wealth. That's typically kind of the flow. So setting goals at different stages is important in terms of building, preserving, and increasing wealth. Some key principles to keep in mind are the time value of money, that is today versus tomorrow. A dollar you get today received in the present is worth more than a dollar received in the future, because you can take that dollar and get a multiplier effect. And I'll talk about compounding in a moment. But I just want you to click on this video from Investopedia when you have a moment in the non-narrated slides and look at and try to understand the concept of time value of money. Compounding is it's better to earn interest than to pay it, and it refers to the effect of earning interest on your interest. So you get interest to compound and work for you, not against you. We'll look at an example where companies were and individuals were too highly leveraged and interest worked against them. But when you think about compounding, compounding is if you have $100 and you invest it today, and maybe you can get a 5% return over that year, then by the end of the year, you'll have $105. And then another 5% return on $105 will yield you more. You get a compound or a multiplier effect. I once had an entrepreneur come to my class. He was also a Cornell Board of Trustees member who had a small tech company in Ithaca that he sold off. But his philosophy early on in the process was, I need to get rich slowly and debt is bad. And he used compounding to grow his business and then retire early. He currently lives between Ithaca and Mexico half the year. In Collins and in the book, you heard about the financial crisis. There were a lot of bad loans, and there was eventually an economic meltdown in the US that impacted the rest of the world. It was called the subprime loan crisis, and it was where banks lent money to people who weren't qualified to pay back the money. And they used something called adjustable rate mortgages. And these were pegged to increase at certain interest rates. So while your interest rate may start out low, it would go up higher or it would adjust over time. And this eventually led to the crisis of credit. There's a really good video link in here that I'd like you to take a look at to understand the crisis of credit, the importance of leverage and being over leveraged, and the fact that so many individuals and organizations were over leveraged. It had an economic meltdown effect on the US economy and even the global economy. And as we think more broadly about the business environment, there are lessons that we can learn from the subprime crisis. And that's when you think about taking out a mortgage or a loan or debt, all mortgages are not created equal. Particularly for your housing payment, maybe avoid those ARM mortgages. You're better off with a fixed rate loan. Knowing what comes in on a regular basis can help you plan for the future better. Or knowing what you owe on a regular basis can help you plan for the future better. Not all income is equally disposable. Watch how much you borrow. If you're constantly borrowing money, maybe not paying off your loans or your credit cards, there's a problem. Be careful. It's risky out there, and in business, there's management risk and business risk and also financial risk. So think about those things. Collins outlines these a little bit. And also there's a film that, if your schedule permits, I encourage you to watch. The film is called Inside the Meltdown, and it looks a little bit at the financial crisis and how Main Street, Wall Street, and the world are all connected. This is a film on PBS, and it's free, so if you click on the link, you can watch it. As you'll see in Inside the Meltdown, housing prices started to go down in 2006 and 2007. Homeowners with subprime or adjustable rate mortgages were not able to pay or refinance their home, and as a result, because they couldn't pay their loan, the banks ended up foreclosing on the house or taking the house back. It became very common at that time. So the banks don't like to be homeowners. They like to loan money and get the money back with interest. But because they couldn't get the loan payments back, they had to take back the homes. In the meltdown, you see a variety of key players from business, government, Wall Street, and even Main Street. When I say business, it's because of the mortgage loan defaults. Banks lost huge amounts of money. The banks were in a lot of pain during that last financial crisis. We may see something similar now too after COVID-19. If people have lost their jobs, maybe they can't pay their home mortgages, and that could have a ripple effect on businesses and individuals. The government carried these costs over to the Fannie Mae and Freddie Mac. Those were the government-sponsored organizations who make and back mortgage loans. So the government was hurting as well. Wall Street, the big investment firms and houses, major investment firms that had been buying subprime mortgages took a big hit. You saw that in the credit crisis visualized. in Main Street. That's just the average people. It became much harder because the banks were hurting, and so there was a credit crisis. Nobody was loaning money, and getting loans became very difficult, and many people ended up losing their homes altogether. So the meltdown was not just a US thing, but because we're all connected in our interconnected world, there was global impact. The financial crisis in the banking industry displayed the weaknesses of the banks and other institutions that had made mortgage loans, and they were the first sector of the financial industry to be hit. But many of these banks and institutions are globally connected. So maybe you heard about Lehman Brothers in the film, in the Meltdown, but they had offices around the world. So many of these banks and institutions that are globally connected also had losses were felt on Main Street, Wall Street, and around the world. And Lehman Brothers and many banks closed or shut down. The world was hurting. Okay, let's review and preview. So in this module, we talked a little bit about corporate financial management. I also spoke to you about personal financial management and gave you an overview of Nike's challenges and journeys related to their own financial management. So now hopefully you have an idea of how to better manage money, both from a business standpoint and from a personal standpoint, and you can relate it to a real company, Nike. In our next class, we're going to look more at your career exploration and career plan presentation. Before your final class in August, there are 4 steps in the career exploration process. On the topic of career exploration, this is where we've been and this is where we are going. First, you've already done a personal SWOT analysis. That's great. That's a foundation for thinking about a career where you can use your strengths and pursue opportunities. Next, you'll start to consider more occupational options. You'll gather career information. You've done some research. You've looked at some job postings on the Tokyo Career Forum, and we talked a little bit about informational interviews as well. I trust that you've been also to the Counseling Center at Kyoto University of Foreign Studies at the Career Counseling Center. Later on, as we move through the month of July, I'd like you to evaluate your career options and think a little bit more about what looks the most interesting and why, and rank your job postings from most to least interesting. And then finally, in our last class, each of you will have an opportunity to prepare, design, and deliver your career plan presentation, and then continue to take action throughout the summer. And we'll stay in touch. Okay, that's it for this class. Thanks for your time and attention.